Hey, today we're going through a research paper from Vanguard titled Setting the Record Straight, The Truth About Index Fund Investing. And I already had, looked inside it a little bit and let's find out together what these truths are that Vanguard wants to reveal to us. To have some, critical reflection of this paper, of course. On the one hand, I feel like Vanguard as a company and their research seems very trustworthy. On the other hand, of course, like Vanguard's big business is selling ETFs. So, of course, I would be very surprised if they were too critical of ETFs in this paper. And it's from August 2025, so pretty recently. As I said, I had a look inside it a little bit. So they're talking about some misconceptions about ETFs, or at least from their opinion, what people have as misconceptions about it. There has been, I think with the success of ETFs, more people that are critical of it and, have some fears regarding how they are interacting with market efficiency and stuff like that. So I think it's going to be an interesting paper to have a look at. But yes, I also haven't read it in detail. I think it's going to be fun to have a look at that together. So let's start. Setting the record straight. The truth about index fund investing. Index fund investing has numerous benefits, including lower costs, diversification, tax efficiency, and relative return predictability. Nothing surprising there. The increased adoption of index fund investing has heightened emphasis on the binary labels of passive and active. That is true. So they increased the adoption of index fund investing. With the index funds, oftentimes they are seen as synonymous with, the passive investing strategy. And because the index fund with their passive investing strategy had so much success, now of course we want to promote more the passive investing approach and not really the active investing approach for most private investors. As if all index funds can be described as a monolithic homogeneous strategy. This has led to many faulty assertions about index fund investing. With this part here, of course, oftentimes you think an index fund automatically will have a passive strategy, but of course that doesn't have to be the case. I think there are also index funds that, run an active strategy. And of course, if you buy a fund on a specific country, specific, company size, or one of the smart beta factors, of course, it's kind of like a mix. On the one hand, it's not an active manager that picks stuff, but of course, on the other hand, you go into this more specific bets, which, maybe you could describe as active, or at least more active on this spectrum between 100% passive, trying to just invest into the world economy, and then, very active. Our analysis displays assertions tied to the growth of index fund investing and offers evidence that refutes key misinterceptions. Of course, on the one hand, I think one of the points they make is for most passive investors, or for most investors, even though they invest with ETFs, that they go into this more specific sector or country bets, and therefore it's they use the ETFs more with an active strategy. And this is maybe not that relevant and interesting for us, because we already know we try to incorporate, the passive investing approach and just buy the world market, as much as we can. But on the other hand, some of the, assertions, there's people that are afraid that, with so much passive investing going on, that maybe the markets are not that efficient anymore, and at some point maybe there's gonna be that we are maybe already in a big ETF bubble or something like that. And if they have some facts or some research that that goes against it, that would be really reassuring for, as normal passive investors as well. Okay, so who are the authors? James Rowley and Stephen Lawrence and Ollie Ryder Green, really cool last name right there. I'm just getting into the habit of reading more, like not just the books, but also, research papers on it. So I haven't seen them before, but let's see. If you have a look, if you guys are interested, having a look at more research from Vanguard, maybe we will see some of them again. So let's go to the introduction. The advent of and access to index fund investing is one of the most significant developments in the investment industry over the past 50 years. Yeah, that's quite true. To be clear, index fund investing continues to offer professional and individual investors alike opportunities for lower cost, highly diversified portfolios with consistent relative return predictability. Yet despite indexing's universal benefits, the continued popularity of index funds among nearly all types of investors across all markets has given way to debates between staunch proponents of passive investing and those of active investing, as well as some notable misperceptions tied to indexing growth. Yeah, that's, I think, quite an interesting discussion, because originally, I think the index funds were there to, have a vehicle to try out and implement, this passive investing approach. But after, the indices with this passive investing approach got so popular, and even the active managers and active funds, they couldn't talk away the success. Now I think, we see with people recommending ETFs, if you go to your local bank and ask for advice, of course, on the one hand, they will most of the time recommend you ETFs, because even for the general public, this knowledge and this notion of that you should probably invest with ETFs is so big that, if they recommend you some, single stock picking advice, even investors that don't know too much about the investing science would be suspicious. But then I think what we see is that, okay, now the, banks, they don't recommend single stocks and stuff that much, but they will give you recommendations for ETFs. And then oftentimes it's just a weird potpourri of all sorts of different ETFs, and which goes more into an active strategy, having this specific sector bets. And these banks, they often do it not because it makes that much sense or they really believe in it, but of course, with each separate ETF you buy, oftentimes the, bank consultant, he can get a cut on that. So on the one hand, initially the indices were mostly for passive investing approach, but I think now we see that, that the industry is kind of perverting this original purpose of the indices to give this, really nice passive and, science backed investing approach, passive investing approach, and, tricking the investors that don't know any better to, at the end, pay more fees than they have to and have a more active portfolio than they really want to in most cases. And then it's an interesting discussion because, well, if you choose to invest in ETFs, the underlying reason for that should be that because you believe and accept that you can't individually stock pick. Because if you could, or you believed that you could, then, why buy an ETF? Just buy, the stock, Nvidia, Apple, or whatever, where you're so sure that they will outperform the rest of the market. But you don't do that. You buy the index and the ETF. But then to get into this, especially I had a video as well about someone recommending the S&P 500, and it's why? If you already accept the fact that you're gonna buy an ETF because you can't stock pick, then what makes you believe that you can stock pick a certain company size, stock pick a certain, country? And while the active versus passive debate may further ebb and flow as the ever-evolving investing landscape shifts, the binary labels of index and active remains less significant than the underlying characteristics of the funds themselves that determine fundamental principles of both index and active investing. Okay, so this is an interesting statement here. If I understand it correctly, they mean that even though we have this discussion about active and passive, that they care more about the underlying assets and fundamentals these indices invest in, besides, if it's just passive or active. Despite these fundamental principles, the fund industry has largely focused on binary labels without adequately considering how index and active funds are used to create portfolios. This myopic view overlooks the broader context in which investors make decisions, including the roles of asset allocation, diversification, and risk management. I must confess I'm not quite sure what myopic even means. Can we look that up maybe? In the future, maybe I should have like a plugin where I can read like the definition. Myopic, pertaining to or affected with or characterized by myopic, nearsighted. Okay, so it means it's a form of nearsightedness. Okay, this nearsighted view overlooks the broader context. Okay. By concentrating on the labels rather than characteristics, the industry has missed the opportunity to provide a more nuanced understanding of investment strategies. I'm not quite sure where exactly they want to go with that, but yeah, it at least seems interesting and more, maybe like for me as well. Oftentimes what I'm, talking about is, passive good, active bad. But yeah, maybe I can take something away from that as well to have like a more nuanced understanding and discussion about it. This paper takes a holistic view of both active and index investing, drawing from a rich body of research that offers detailed insights into how investors make decisions about diversification, asset allocation, costs, and risk. It aims to refute several notable myths surrounding the continued popularity of index fund investing. By dispelling these misperceptions, we seek to provide a clearer and more balanced perspective on the role of index funds in modern portfolio construction. Indexing has democratized investing and promoted investors' interests through its many advantages. Over the past several decades, index funds have democratized investing across the globe. The benefits are numerous and clear. Indexing has provided the foundation for a broad spectrum of investors to realize their financial dreams by widening access to capital markets. Indexing is an investment approach that seeks to track the performance of a specific benchmark or index. Instead of trying to pick individual winning stocks, indices hold all or a representative sample of the securities in the index that's being tracked. Investing in funds that track these indices is sometimes referred to as passive investing. I mean, I'm not sure if I would say like sometimes. I feel like that's, what most people would understand under this term. 5 key benefits of indexing. Indexed products, including mutual funds and exchange-traded funds, ETFs, boast a range of advantages for investors. First, diversification. Maintaining a well-diversified portfolio is an essential part of a successful investment plan, because diversification is one way to reduce volatility. Indexing can be an ideal way to achieve that diversification. After all, an index typically includes more securities than an actively managed fund that is trying to outperform that index. Although the diversification that an equity index fund offers can't protect against broad equity market declines. It can reduce the risk posed by a dramatic decline in any one security or economic sector. Second, low costs. Index funds boast a powerful advantage when it comes to keeping costs low for investors. They often have lower expense ratios, as they cost less to manage and operate, given that they don't require large investment teams to analyze and select securities. Index funds use a buy and hold approach, which promotes lower transaction costs. The securities within index funds are generally subject to less turnover than those in funds directed by active managers. This reduces the brokerage commission and other expenses incurred when trading securities. These points we are talking about here, I think, they're not that interesting, more common knowledge. But of course, on the other hand, this is mostly what you think about when investing in an ETF or index. But of course, like this active, trading strategies and, trying to trade a lot, you could also do with an ETF. For example, if you have like an, active trader and they think they can, predict if, the world economy is going up or down a slight little bit in the next, hours or minutes or seconds for whatever reason. For example, if they, think they have some idea, what Trump is going to say next for his next press release or something, then you could also, I suppose, trade a lot and do active trading strategies. For example, trading with the FTSE All-World or similar. Low costs, whatever in the form of expense ratios or transaction costs, are essential for investors who want to maximize their investing power over time. Even seemingly small costs, such as fractions of a percentage point on a fund's overall expense, can significantly reduce a nest egg over multiple years. Third, consistent relative return predictability. Because of their diversification and low costs, index funds can be an effective way to achieve consistent and competitive returns over the long run. Note that past performance is no guarantee of future results. These funds' shared objective is not to exceed their target index, but simply to match its performance as closely as possible. For many investors, retirees or near retirees, for instance, such predictability of relative returns is itself valuable. For this, I'm not 100% sure. Sometimes we do have it that for whatever reason, the ETFs outperform their indices slightly. Because they of course try to, match the index performance. It's not going to be like a strong out or underperformance in most cases, but sometimes with like securities lending and stuff, and if the fund gets lucky with its rebalancing and stuff, they can outperform their target index. But then for like these funds' shared objective is not to exceed their target index. On the one hand it's true, but on the other hand, if there was like a way for the index with, some security lending or stuff to outperform the index, then of course I think they would try to do that, right? So even though of course like the idea of the index is that they think, well, we can't outperform, or the idea of the ETF is to think, well, we can't outperform the index, so we just try to track it, right? But with like security lendings or whatever, like if they had the chance, like of course they would try to take it to, be better than the index, even though like they probably this wouldn't be their goal, because they think, like probably they can't outperform the index. But for the objective, it's to track the index as close as they can. But if there is a chance, then, of course they wouldn't feel bad if they outperformed the index, right? But then again, maybe like, of course, maybe I guess they're correct, because for the ETF providers, of course, they will not, their goal is not to outperform the index. Track it closely, because even these outperformances are probably not subject to, like, because they are that good at it. It's sometimes just by random chance that they perform better because of, like some lucky rebalancing or some lucky, other things and they can do to a small extent. So yeah, like if they could, I'm sure they wanted to outperform the index, but it's not a useful goal to have, because I don't think, we can't believe that we can do this on a, persistent basis based on skill. So we try to perform the index as closely as possible, but, sometimes because of luck, we could outperform it. And of course, mostly because, running an ETF is, there are associated costs with it that, most of the time, I guess we will underperform and have a slight negative performance compared to the index we are trying to track. I mean, performance difference. For many investors, retirees, we already read that. Now 4. Potential for tax efficiency. Index funds typically have lower portfolio turnover. That is, their holdings are traded less often than actively managed funds. Most index funds therefore tend to realize and distribute only modest capital gains. This is particularly important for investors holding index funds and taxable accounts. Taxes eat away at actual returns. The significant long-term impact of even small costs make the tax diminishing potential of index funds a vital consideration. 5. Simplicity and transparency. There's nothing opaque about how index funds are designed and how they operate. They have a precise, easily understood objective to track the performance of a specific fund. I mean, on the one hand, that's true. On the other hand, of course, for us, who are not too deep into all this, how would I construct like a fund on like the financial mathematics? Of course, we understand this goal, what this fund and ETF is trying to do. On the other hand, how specifically this day-to-day works, how they track this fund, and all these considerations, and what they actually, these fund providers are doing, is of course, I would say, opaque to us, normal investors that are, don't have a job to, work at these fund providers. Well, of course, simplicity and transparency on the one hand, it's true. On the other hand, if I had to explain to someone how exactly the FTSE All-World works day to day, even though I own it, of course, then I wouldn't be able to explain that in specific detail. And then also for the indices, for like the normal ones, of course, that is true. But of course, you have like indices that are leveraged and using like, trying to use some smart beta factor and whatever. And then, of course, it gets more complicated. So yeah, it's true for, to a high degree for like the standard indices and ETFs, but of course, like you can make it more complicated if you want to. Zero-sum game theory and relative performance predictability are universal. The case for an indexing strategy rests on the zero-sum game theory, noted by Sharp, 1991. Wow, that's quite surprising. Like, of course, I know that, Sharp is like, has some interesting papers or like important papers in that field, but didn't know this was like so recent. 1991 is not that long ago. It asserts that 1. Before costs, the return on the average actively managed dollar will equal the return on the average passively managed dollar. And 2. After costs, the return on the average actively managed dollar will be less than the return on the average passively managed dollar. Contrary to popular belief, the case for indexing does not rest on market efficiency. This part about Sharp, I remember it from, the passive German passive investing Bible, Souverän Investieren from Gerd Kommer. The case Sharp made there. But this is then, I wasn't aware of that much, that the case for indexing does not rest on the market efficiency. That is an interesting point to make. Active management strives to outperform a benchmark by taking active bets against it. A number of active funds achieve outperformance, some even by large magnitudes, but other funds underperform, including those that do so by a large magnitude. Predicting which active funds will outperform is difficult. By contrast, indexing strategies aim to track a benchmark, thus greatly minimizing the range of performance outcomes relative to it. Expense ratios are typically lower for index funds, promoting performance and worth accumulation. Costs, such as expense ratios, track on fund performance, regardless of whatever a fund is categorized as index or active. Even though index funds tend to have lower expense ratios than active funds, the inverse relationship between expense ratios and fund performance applies to both. Active funds with relatively lower expense ratios effectively lower the hurdle to achieving outperformance. In addition to performance benefits, lower expense ratios support worth accumulation. For this part, I'm not quite sure. On the one hand, of course, it's quite logical, lower expenses will be better for us investors in the long run. And especially the difference between passive and active approach, like the active funds, they will probably have higher expense ratios and they're not doing anything useful with it. But then on the other hand, we have this thing where, if we try to find the best, for example, passive world ETF, that I don't think we can just select the one with the lowest expense ratio because, they are not a 100% guarantee that this or that fund with the lowest expense ratio will also perform better than the ones that have slightly higher expense ratios. And then it's more, not necessarily about the expense ratio, but more about the tracking difference. And then the question is is the expense ratio, is it correlated that much to the tracking difference? Ideally, of course, we want to have, a positive tracking difference performing ideally better than the index, or at least, have the best tracking difference of the ETFs we choose. And for that, I would be interested to find a paper talking about that specifically as well. So I'm interested, or I think it's interesting that Vanguard puts such an emphasis on, the lower expense ratio. I think when comparing passive and active indices, that makes sense because the higher expense ratio of active indices will, go into not that effective stuff, trying to do the active trades and stuff. Therefore, you want taking a fee, but what you're doing actually doesn't make that much sense. But if you're talking specifically about, passive indices, tracking the same indice, I'm not sure if, especially if we're talking about an efficient finance market, if for some reason, an institutional investor found out that, this fund has a lower cost, therefore we assume it will perform better, then, wouldn't they be willing to pay a little bit more for it? And therefore, the difference between the funds would equal out. And the difference at the end of the day, we can see between the passive funds that just track the world economy are more, then again, based on a, random walk, how it behaves with the single stock picking. For that, I'm not sure, but let's see if they, touch upon that a little bit as well. That index funds tend to have a lower expense ratio than active funds means that investors can keep more of the assets working for them. Figure 1 on page 5 shows that the assets asset weighted average expense ratio for index funds has consistently been lower than that of active funds. Okay, and they say that asset weighted average expense for index funds, okay, lower than active funds. Yeah, which makes sense. Let's see at page 5, figure 1. Index funds have helped drive down the cost of investing. Okay, we see the cost asset weighted average expense ratio. Okay, that's interesting. So it went for active funds for about 1% down to 0.6. And for index funds, wow, they already started pretty low, little bit over 0.2, and now going more down. But yeah, this is what exactly are we talking about here? Notes: data are as of December 31st, 2024 for US domiciled funds based on annual report net expense ratios. In this hypothetical example, data assume that index investors would have invested in active funds had index funds not existed. Data reflects the difference between the cumulative expense ratio fees paid by investors owning open-end funds and what they would have paid if index funds didn't exist. Investor savings are calculated as asset-weighted expense ratio of actively managed funds multiplied by industry assets minus asset-weighted expense ratio of index funds multiplied by industry assets. So, okay, source Vanguard calculations using data from Morningstar. Interesting that Vanguard is, I thought they would have like their own data to draw, but okay, they're using Morningstar. And I mean, I do think like this figure seems like trustworthy, but interesting to know that it's not just like an easy comparison, but they make some assumptions here. Also interesting to see that the savings went up. Maybe here it was like maybe because of COVID, people couldn't put that much savings into it anymore, but now it's rising again. Okay, let's go back where we had been. Figure 5. Okay, as of December 31st, 2024, the average expense ratio for index funds was 0.09%, compared with 0.56% for active funds. Wow. I mean, of course, I think they're talking here like about the US values, because for European investors, normally, the cost for the funds is a little bit higher, like 0.09. That's crazy. It also kind of makes you wonder, like, I mean, how low can this get? Of course, like if you're talking about this massive trading volumes, even, 0.09% of like billions and trillions of invested capital still, will be a lot. But yeah, you wonder, like, will this go even lower in the future? And like, where's the bottom, how low can this go? Compared with, so active funds, I mean, still, it's not that as much as I would have expected, but yeah, compare this. This is like times like 7, 8 or something for active funds. While both expense ratios have fallen over time, the difference reflects the performance and wealth accumulation advantage for index funds relative to active funds. And yeah, of course, you have to think about it. I mean, both these numbers seem incredibly low, but if you can choose, which one would you prefer? Of course, I think this one. Of course, if also we are talking about that, performance will, with the additional benefit of that, you would assume the index funds to perform better as well. And then like this difference also puts a lot of like pressure on the active funds. Already, they're so much lower. And then, for you to believe that it makes sense to invest into the active funds, they would have to outperform to make it worthwhile to, reach, come closer to that. Figure 1 also shows the annual savings realized by index fund investors. Our estimates show that in the absence of index funds, investors would have cumulatively paid roughly 503 billion US dollars in additional costs due to higher expense ratios since 2000. Realized by index fund investors. So, in the absence of index funds. Okay, so what we see here, like this active funds, this is like they assume like what would be if there were no like index funds at all or something. We further believe that index funds have induced competitive price pressure in the industry, at least partly explaining the downward trend in active fund expense ratios. The trend is noteworthy because it reflects a diminishing revenue source for asset managers, whose business incentives run counter to the trend. Regardless of the cause, declining expense ratios benefit all investors. Yes, that's true, and for asset managers, these numbers and these figures is kind of concerning. On the other hand, thinking of like private equity, I haven't read a paper about it recently, but I do believe I heard someone tell me that, I think in general, like the private equity, maybe it will change in the future. Now having ETFs and more funds that try to directly invest into private equity. But I do think private equity is not, this private equity market is not as efficient as the rest of the stock market and financial markets, and not really that attractive to invest in for private investors. But of course, you have always these, high net worth investors who are always willing to, take a bet, take a risk. And with these, private equity firms and these fund managers, of course, like this story of private equity, you always have like a much more interesting story to tell than just this boring passive investing approach. So even though if the fundamentals say it doesn't make sense at all, like probably will not go anywhere. Recently I saw a video on YouTube and they said like there are now more private equity firms in the US than there are McDonald's. So obviously, even though it probably doesn't make sense fundamentals and statistics wise, there will always be, unfortunately, a market for selling this kind of services. Oh, well, I mean, on the other hand, if you are an asset manager, or for me as well, looking into, also maybe offering asset management services, that's maybe also some part of hope. I mean, for me, of course, I'm not talking about selling like private equity that doesn't make sense, but more in the sense of like, for people that also just want to offer this service of like having this knowledge about passive investing and whatever. Regardless of the cause, declining expense ratios benefit all investors. That's true. I mean, imagine, if we didn't have like the index funds and all this passive investing, then, well, why would the active funds have interest in lowering their expense ratios? Understanding the continued popularity of index fund investing. The growth in index fund adoption has been supported by the benefits of relative performance predictability and low cost. Figure 2 on page 5 shows the percentage of equity market capitalization held by equity index funds in several countries or regions. We recognize an alternative estimate of the proportion of equity market capitalization held by passive equity strategies, attributed to Chinko and Salmon, 2024. Our estimate considers only mutual funds and ETF assets, as it allows us to provide a consistent estimate for markets outside the US. Well, very good that they also consider the markets outside of the US, for finfluencers and, firms Most of the big ones, of course, are located in the US. That's not always a given, but very nice. The extent of the adoption, however, tends to be summarized as if index funds constitute a single monolithic strategy. Such a summarizing fails to recognize the multitude of strategies employed by index funds, as well as how investors use individual index funds in the context of overall portfolio construction. They touched upon that point in the introduction as well. I mean, back in the days, you would think like ETF, index fund, automatically that means a passive investing approach. But of course, like if people use index funds and ETFs to incorporate an active trading strategy into their portfolios, then, what does it really tell us? If we just look at the index fund numbers, if people especially private investors are still, falling into this trap of the active investing light, then that's not good, regardless if they are like stock picking or, index fund picking. Okay, and here figure 2, index fund assets as a percentage of market capitalization. United States, 23%, as a percentage of market capitalization, percentage of equity market cap. So I would assume this means how much of the market capitalization is inside index funds. Notes. Data as of December 31st, 2024. US equity fund market share is represented by assets of equity funds worldwide allocated to US equities, plus asset funds in a Morningstar Global category containing US equity in US dollars. Blah, blah, blah. I think even for me, I will not read this small text. Since 1990, assets held by index funds have increased globally, but so has the diverse array of index funds and the underlying strategies. Figure 3 shows equity index fund assets under management as a fraction of global market capitalization over time. Funds have been separated out, first by their broad investment objective, and second by the benchmarks. While index fund investing has grown steadily since 1990, this growth has clearly not occurred monolithically through investments in the same securities. Rather, it has grown through an increasingly diverse array of index fund offerings, tracking thousands of indices, each with a different stock composition. Index funds do not, in fact, constitute a monolithic, homogeneous strategy. Let's look at what they actually mean by that. Figure 3. Index funds comprise an increasingly diverse array of strategies. Percentage of global equity market capitalization. Okay. Since 1990. Category, number of distinct benchmarks. Other equity, regional equity, global equity. So basically they mean how much people buy like the ETFs and which kind of ETFs they buy. So if you went by like the hardcore passive investing approach, then all of this should be just invested into like the global equity, right? But yeah, the US markets are very, very popular. Also, so many YouTubers and influencers always, promoting the S&P 500. So what exactly do they mean with this data here? Data are as of December 31st, 2024. The chart depicts the net assets in US dollars of equity index mutual funds and ETFs worldwide as a fraction of the market capitalization of the MSCI All Country World Index in US dollars. Depicts the net assets in US dollars of equity index mutual funds and ETFs worldwide as the fraction of the market capitalization. So basically they take the market capitalization of this index and see how much of US dollars is invested into the ETFs and mutual funds, I suppose. So if like the market capitalization of the MSCI All Country World Index was that much invested into ETFs and mutual funds, then we would be for 100%, but we are not, closing in on the 25% rather. Funds are, and even then, this of course doesn't mean just because we invest like the market capitalization of the MSCI or country world doesn't mean that we invested into the same assets if we invest so much into US equity instead. Compromise, okay. Total US market compromise all funds tracking broad market benchmarks for US equities, and global total market equities comprises all funds tracking broad market benchmarks for global equities. US style-based equity comprises funds within the global category. Blah, blah, blah. Yes, yes, yes. Blend is separated. Morningstar. Regional equity comprises all international equity, not otherwise classified as global equity. Shading variations within categories are illustrative and depict distinct benchmarks used by funds within a given investment category. Some distinct benchmarks are occluded for visual acuity. Distinct benchmarks are defined as any named benchmark, excluding variations due to reported currency and return types. For example, the price and total return versions of the same underlying benchmark are considered a single distinct benchmark. For example, the price and total return versions of the same underlying benchmark are considered a single distinct benchmark. Okay, so they're taking them together, I suppose. The MSCI All Country World Index was chosen for its historical longevity and targets about 85% of global investable equities. It excludes many small cap and micro cap stocks that are often held within index funds, thus overstating the overall ownership fraction. Source: Vanguard calculations using data from Morningstar Inc. and FactSet. Okay, FactSet I have not heard before. Let's go back. Where were we? Okay. Funds have been separated out first by the broad investment objective and second by the benchmarks. While index fund investing has grown steadily since 1990, was not monolithical. Investors have used this diverse array of index funds to implement actively oriented portfolio strategies. A truly passive portfolio would be one that tracks a total market index. Very correct. Even a portfolio that holds a large cap growth index fund to capture exposure to US equities would be an active portfolio relative to the US total market. Even a portfolio that holds a large cap, yes. And for this, I think we can also put the S&P 500 that holds a large cap. Even large cap growth, yes, but I'm not sure if the S&P was under, but because the S&P 500 only has the 500 largest US companies, I think that would go at least to large cap. And for this growth, I'm not sure if that's specifically a smart beta factor. Yes, would be an active portfolio relative to the US market. This is, I think, very, surprising that even though the idea originally of the ETFs was to have this global equity strategy, we can see that, most of the investors are actually not using the ETFs for this purpose. Rather, they pump a lot of money specifically into US sector bets. If we see here the global equity, it's a dark blue one. It's so small you rarely can even see it. We employ the methodology used by Black Wang and Rowley 2022 to demonstrate that the performance of a portfolio consisting of US equity index fund investor assets reflect that of an active portfolio. Yeah, that's a good point to make. Even if more people now use the ETFs and index funds and mutual funds, what's the point if they're actually it's just stock picking in another dress if we have this very concentrated US sector bets. But at least, I guess it's an improvement to invest into the S&P 500 over the traditional just stock picking individual companies. But still, it's concerning. Figure 4. I mean, of course, for the big banks and companies, they, can do whatever. But I think it's also a lot of, private investors taking this huge bets onto the US market oftentimes, even though it's not really necessary and recommended in most of the cases. Figure 4 shows the asset-weighted excess returns of 3 representative portfolios relative to a proxy for the total US stock market. The portfolios consist of equity index funds, whose objective is to track the total US market, equity index funds, whose objective is to track a subcomponent of that market, for example, large cap growth and traditional US active equity funds. These portfolios essentially reflect the aggregate performance of what are known respectively as total market index fund investors, non-total market index fund investors, and active fund investors. The total market index fund portfolio reflects the truly passive portfolio approach to gaining exposure to the US stock market. Its excess returns sit in a tight range around 0, approximating a flat line. The active funds portfolio would be expected to demonstrate considerable variability around 0. However, the non-total market index funds portfolio also demonstrate substantial variability around 0 in that regard, appearing to be an active experience. These results suggest that many index fund investors use passive for active exposure. Okay, active funds, non-total market index funds, and total market index funds. Yeah, compared to the non-total market index funds and active funds, these are unfortunately pretty small in comparison. Again, data on this date. Excess monthly returns are relative to the Dow Jones. Okay, Russell 3000. Debunking notable myth associated with the growth of index fund investing. Despite the diverse area of individual fund strategies and wide-ranging use by investors to build their portfolios, the increased adoption of index fund investing has led to many faulty assertions surrounding it. Okay, now I guess we are getting to the more interesting stuff. Market cap weighted index funds haven't made the largest stocks larger. It is often believed that market cap weighted indexing makes the largest stocks larger and therefore reinforces market concentration. Market cap weighted index funds don't do either because of market cap weighting itself. A market cap weighted index fund invests in each stock proportional to stock's market cap weighting. This does not make any stock larger than another, and thus does not reinforce concentration. For example, if an index fund invests 1 million in a portfolio, which stocks A has 3% weight and stock B has 0.01% weight, and the funds allocated 3% to stock A and 0.01% to stock B. These allocations are in line with each stock's existing market weight and thus would not make stock A incrementally larger than stock B. Makes sense thinking about it in this way. In practice, US equity index funds' highest proportional ownership is in mid mid-cap stocks and not large caps, figure 5. Each point on the figure represents the rank order of a stock in the Russell 3000 index by size and its corresponding aggregate ownership by index funds. Moving along the figure's x-axis would be here, right? Stocks increase in size and aggregate ownership by index funds tend to increase. The highest level of ownership by index funds, however, are reached around the mid-cap range, after which ownership amounts begin to decrease. The largest stocks possess lower aggregate ownership amounts than mid-cap stocks. Several factors could explain this, but Plug, Wang and Rowley 2022 highlight that an aggregate portfolio of index fund investors tilts away from large caps. Highlights that an aggregate portfolio of index fund investors tilts away from large caps. Okay, I'm not sure exactly why that would be the case, but I suppose the case they want to make is index fund don't own an outsized share of large caps. Yeah, okay, that for some reason the index fund, they rather own percentage of market capitalization. Okay, yeah, so I suppose the index fund mostly, even though you always think they own a lot of the large caps, they mostly have a higher percentage of ownership in the mid caps. Even if index fund investors were truly passive and aggregate, if they all simply held the market, the relationship would be a flat line. That is, each stock would be owned by index funds in equal proportion. Okay. So if we all did what we are supposed to do as private investors, not necessarily talking about institutional investors and banks, of course, that hopefully know what they're doing, then this would be more a rather flat line. Wouldn't have like this. Given the diversity of equity index fund offerings and investors using passive for active, it should not be a surprise that index fund ownership of stocks is not market cap proportional. Index funds have not made the largest stocks larger. Okay, so I think this is a common concern of people to have, and it's nice that we can put this to rest. The growth of index fund investing doesn't inhibit price discovery. That's also one of oftentimes an argument against the index funds now that they became that popular, that people are concerned, well, if everyone is just using passive investing approach and just the index funds, then who is actually, responsible for, discovering the true price? And, if that fails, maybe at some point, there's going to be a big correction because no one actually paid attention to, which company should be which price. And let's see what they have to say about it. But I think, for me, my impression would be that, right now we have much more people still, doing active trading and trying, there's so much effort going into price prediction that is too much, not useful anymore. That even though, of course, if at some point everyone would stop and try to find better prices themselves and we would 100% just have passive investors, I'm sure that would be a problem. But as it stands now, I think still our concern is more that even private investors that have no business actually doing that still try to, outperform the market. So even though, of course, theoretically, it would be a concern, it's not a concern we should have right now because it doesn't seem like anytime soon people will, try to outpredict the market even though they don't have a chance. At least this is my impression right now. Let's have a look at what Vanguard is actually saying. It is commonly argued that index fund investing leads to too large of an influence on price because of too much trading, or that it perhaps leads to less price discovery due to limited trading. We apply the methodology used by Rowley, Zarina and Zhu 2019 to determine the extent to which this is true. Figure 6 shows the fraction of US equity trading volume attributed to the portfolio management of index and active funds, as well as the overall level of trading volume across US exchanges. Index fund trading volume constitutes just over 1% of total trading activity, although active fund trading volume is higher, 2% of total volume. Index fund trading volume constitutes just over 1% of total trading volume, although active fund trading volume is higher. Okay, so the active fund trading volume is like twice the size of the index fund trading volume. Mutual funds and ETFs remain a small part of overall market activity. Broker dealers, market makers, and other investors constitute the lion's share of trading activity every day. Trading volume has slowly increased from about 38 trillion in 2006 to about 153 trillion in 2024. During that period, active fund volume remained between 2% and 5% of total trading volume. Active fund volume, okay. Interesting. Then I wonder if like active trading makes about 2 and 5% and the index fund trading volumes are even lower, like what the rest of the 90% trading volume would be. But index fund trading volume slowly grew from about 0.3% of total volume to 1.2%. Index funds are an important source of ownership, but they claim that they are becoming the primary driver of market dynamics is demonstrably false. Index fund investing leaves ample room for price discovery. Okay, this also sounds really reassuring, but of course, on the one hand, Vanguard and the Vanguard research seems trustworthy to me. On the other hand, of course, well, they offer like the ETFs and index funds, so I would also be surprised if they were too critical of their own business model and the products they offer up. Just, for critical reflection and, Figure 6. Index fund trading volume is a drop in the bucket. Percentage of total trading volume. Index open-end funds and ETFs. Okay, so these are passive trading volume, and active open-end funds, ETFs and LHS. Okay, not sure what exactly they mean by LHS, but okay, so the active trading volume seems to go down while the passive trading volume goes up. Interesting to see what happens, once these lines, if they in the long run, if they will converge to each other or not, and if that had any implications. And then the total volume always, that's interesting. So this is just the percentage, and here they just have the total trading volume. And the total volume has gone up considerably since 2019. Okay. But well, if both of these are just, 2% plus 1%, so what is the rest of the 93%? I suppose a lot of, banks and whatever doing having high, daily trading volumes. Increase in index fund investing doesn't spur or intensify market volatility. Negative assertions question the role of index fund investing during periods of market volatility. Specifically, has the growing fraction of assets owned by index funds increased such volatility? Yeah, this is also an concern in general. I would say that the ownership, big ownership of these index providers into the stocks would increase the volatility. So if you have the active market participants, but maybe BlackRock or whatever owns 80% of one stock, that even small trades from the active traders, that these trades would be like, get higher in volatility, because like then the index fund providers, they wouldn't like critically think about the active trades that are made, but just try to follow suit. And if you had like a really large portion of this passive trades just following these active trades, maybe there's some concern regarding volatility. We employ the methodology used by Surina et al. 2019 to answer this question. Figure 7 shows the lack of a relationship between US equity index fund assets as a proportion of the US stock market and two proxies for market volatility. It provides compelling visual evidence that while index fund assets have consistently trended upwards, volatility has not commensurately done so. And notable spikes in volatility are clearly associated with notable market events, such as Black Monday in 1987, which preceded any meaningful prevalence of index fund assets, the 2008 global financial crisis, and the COVID-19 pandemic in 2020. Even during periods of volatility, markets remain resilient. Pingle, Lawrence, and Rodemeyer 2023 tested the relationship between market volatility and volume stocks in the Russell 3000 index from July 2008 through December 2022. They showed that when market volatility increases, so does the volume of individual stocks. They showed that when the market volatility increases, so does the volume of individual stocks. They also showed that this relationship holds for stocks regardless of the typical trading volume levels. Market volatility is unrelated to index fund assets. Historical volatility and VIX. Okay. So we have this historical volatility and then VIX. I'm not exactly sure what they mean by that. And percentage of index fund assets. Yeah, as we can see, the index fund assets went up. And then the historical volatility spikes, but they more in common with the macro shocks for the stock market and economy we had, and not necessarily that they go higher as we go higher in the percentage of index fund assets. Okay, notes: data are monthly and are as of December 31st, 2024. The percentage of index fund assets is defined as net assets invested in US equities through all index funds worldwide as a percentage of the total market capitalization of the Russell 3000 index. Historical volatility is defined as the standard deviation of Russell 3000 monthly returns. Time series begin at different dates, reflecting the respective data availability, and x-axis labels mark year ends. Russell 3000 index returns are available via FactSet from January 1980. Represents the monthly price history of CBOE volatility index available via FactSet from January 1990. Data for the percentage of index fund assets are available via Morningstar from December 1990. Past performance is no guarantee, blah blah blah. The performance of an index is not an exact representation of any particular investment, as you cannot invest directly in an index. That is true. Okay, so as you can see, at least it seems like that even though now the index funds have like a higher percentage of ownership than ever before, at least it does not seem like they are increasing volatility in the market necessarily, and the high increase in volatility is more of general shocks in the economy and not of higher ownership of indices. For stocks at various levels of typical daily volume, Figure 8 shows the change in volume when volatility doubles. The figure's first bar includes stocks in the 5th percentile of volume, that is, those with the lowest volume levels. Those stocks' volume increases by roughly 25%. when volatility doubles. Moving along the figure's x-axis and thus observing this relationship for stocks with higher volumes, we see that the response is not dissimilar. Stocks with relatively lower levels of volume appear slightly more likely to see an increase than those with higher volumes. It is still the case, though, that across the volume spectrum, a stock's trading volume increases by roughly 20 to 25% when volatility doubles. This suggests ample liquidity when volatility spikes. The relationship between volatility and volume, much like the overall volatility level, is not tied to the growth of index fund investing. So basically what they want to say is if the volatility increases, also the trading volume increases. Index fund investing doesn't limit active managers' ability to perform. Some claims assert that the growth of index fund investing enhances the co-movement of stocks, thus limiting the opportunities for active managers to perform well. Volatility is the variability of the market's returns, whereas dispersion is the variability of individual stocks' returns around the market return. Let's have a look at that again. Volatility is the variability of the market returns, yes, whereas dispersion is the variability of individual stocks' returns around the market returns. Yeah, so if we had zero dispersion, then all the stocks would perform the same, and then how can I even, then it doesn't make sense to stock pick anymore if all stocks perform the same, right? So if we do have some dispersion, that would mean that also active managers would have a chance to outperform, I assume. Critically, dispersion captures the magnitude of variability around market returns, rather than simply the general direction of movement, and represents the opportunity for stock selection. Active managers seek to add value by trying to pick outperforming stocks or avoid underperforming stocks, or both. Markets remain resilient in the wake of volatility. Sensitivity of volume in response to doubling volatility. Sensitivity for volume in response. Okay. Least volume, most volume. Okay. I'm not 100% sure what they want to tell me with that figure, but it seems like at least the point they make is, that volatility increases, also volume increases. And yeah, something new I learned is dispersion compared to volatility. And now figure 9 shows the lack of a relationship between the growth of index fund investing and dispersion. Figure 9 shows the lack of a relationship between the growth of index fund investing and dispersion. Okay, yeah, that makes sense. So if a growth of index funds would be connected to a decrease in dispersion, that would therefore mean that, active managers have less opportunity, for doing trades and trying to outperform the market. And if that were the case, then also, that maybe would be a concern about the long-term health of the stock market. But yeah, if that's not the case, then I suppose maybe that's a good sign. We measure dispersion as the fraction of stocks in the Russell 3000 index that have either outperformed or underperformed the index by at least 10 percentage points in a given calendar year. Okay, so the way they measure dispersion is by at least 10%. Do they have some explanation exactly why they choose this? For example, suppose the index return is 10%. Our dispersion metric captures stocks whose return exceeds 20% and stocks whose return is below 0%. Okay, that makes sense, but I'm not sure exactly why they choose this 10 percentage points. Of course, also, there will be opportunities for fund managers to also, if they can find stocks that just perform 1% or 2% better than the general stock market, that would also be, good for them, right? But I don't know, I just learned the word dispersion anyway, so I'm not sure if that's common way to measure it. I wonder like why you wouldn't just, why you have to set a cap anyway? Can't you just be, just capture all the dispersion regardless of the 10%? It provides compelling visual evidence that while index fund assets have consistently trended upwards, dispersion has not materially changed over time. Dispersion has fluctuated with apparent randomness around 70%. For active managers, dispersion levels around 70% represent a great opportunity to add value, conditional on effective stock selection. For this I'm not quite sure because, the reason why this passive index funds go up in ownership is because it seems like there's not really much opportunity for active managers to outperform, right? So why would they say that 70% is a great opportunity for them? On the one hand, it would be a great opportunity if they could outperform the market. But yes, I guess then also it's kind of the question like is there like a point in dispersion where active management makes sense? But on the other hand, like even if you have very high levels of dispersion, if you can still not, depending on skill, predict, which stock will outperform or not, then maybe the level of dispersion is irrelevant. Even though, of course, like if there's no dispersion, then there's no point in active stock picking. But even with high levels of dispersion that, if we can't predict it statistically relevant, then based on our skill, then also doesn't really matter, right? So yeah, for that I'm not sure, but I think I get what they're saying. So when viewed at the individual stock level, dispersion can be quite extreme. Figure 10 shows the 5 stocks with the highest return and the 5 with the lowest return in the Russell 3000. And again, it's interesting. Of course, it's just a short paper, not like a classical, paper they sent to with a lot of pages, right? But I think it's interesting that they choose even before. I think choosing the MSCI All Country World made a lot of sense. So why are they choosing the Russell 3000 now? I don't necessarily think like it's the wrong thing to do. Maybe, the Russell 3000 has like more available data or something, but why not just stick to the MSCI All Country World? But yes, it's just a few pages, so it makes sense that they can't explain everything in a lot of detail, how you would normally want this for a scientific paper. Index for calendar year 2024. For investors, such variability in individual stock returns highlights why the properties of broad diversification are so critical. In short, the increase in index fund assets has not altered dispersion level. In short, the increase in index fund assets has not altered dispersion levels. Figure 10. Individual stocks display extreme dispersion. Wow, okay. A dispersion of like over 800%. Do we know any of these companies? No. Okay, conclusion. Index funds provide notable benefits for investors. Investing in low-cost index funds that track a market segment with relative performance predictability can help investors achieve their goals with approximately 500 billion of costs saved since 2000 in the form of lower expense ratios for index fund investors. Yeah, that's a crazy amount to think about actually. Misperceptions about the growth of index fund investing should not distract from this fact. Appendix. Figure 11 on page 14 shows how much the Vanguard S&P 500 ETF, VOO, would hypothetically acquire of the 5 largest and 5 smallest stocks for different net cash flow amounts. VOO would acquire each stock based on the stock market cap weight, regardless of the size of cash flow. In the figures scenario 1, the Apple stocks 7 6.71% weight equates to 849,468, while the 0.01% weight of the Mohawk stock equates to $1,496 US dollars. In scenario 2, a cash flow 100 times larger than scenario 1, VOO would still acquire Apple at 6.71% weight and Mohawk at 0.01%. And just as the 84.9 million US dollars acquired in Apple in scenario 2 exceeds the 849,468 US dollars acquired in scenario 1, the 149,628 acquired in Mohawk in scenario 2 is larger than the 1,496 in scenario 1. Also noteworthy is that for a given cash flow amount, VOO would acquire roughly the same percentage of shares outstanding for each stock. For a given stock, the 100-fold increase in the percentage of shares outstanding acquired in scenario 2 is proportional to the 100-fold increase in cash flow. I'm not quite sure what they want to tell me here, but basically scenario 1 is a normal amount and scenario 2 is like, cash flow times 100%. And while of course the cash flow increases, like the percentages stay the same. Market cap weighted index funds don't make one stock larger than another because we just buy them, on market capitalization, I suppose. Shares. Here we have the weight, dollars, shares, percentage of stock shares outstanding, percentage of stock shares outstanding. Okay. Scenario 1, cash flow. Scenario 2, we have much more cash flow. I suppose they want to make the case that, even if we, do our cash flow times 100, this doesn't really, change the stock percentage because we still just buy them, based on market capitalization. Okay, here, dollars, 149,000. Okay, and they just do everything times 100. Okay, so then this makes the point, like even if the, the trading volume of the index funds would increase dramatically, that it still, really doesn't change the size of the largest and the smallest stocks and whatever. Okay, here we have the references. Have a look at that. The passive ownership share is double what you think it is. Okay, why true passive strategies are rare catches. Considerations for index fund investing, considerations for active fund investing are written from the same people. Resilient liquidity, the robust reaction of equity volume and spreads to market volatility. And we have how investors use passive for active. Yeah, that's what we talked a lot about in this paper. No matter if active or index fund, investors are home biased. Yes, especially with all these S&P 500 recommendations. Active, passive, special issue. Guest editor's letter. A drop in the bucket. Indexing shares of US trading activity from Vanguard and Sharp. The arithmetic of active management. Then, with greater uncertainty comes greater volatility. Okay, then going and trying to summarize this paper again, they talk about, truth about index fund investing and maybe, try to calm us down for some of the common, concerns about, increases in passive and index investing strategies. And well, they talk about the benefits of indexing, but they're not that interesting because they're already well known, not that much interesting stuff there. Same here. Of course, index fund investing is popular. Then the point they make here is, well, the costs for active and index fund investing has downtrended, and it also seems like, maybe the difference gets a little smaller, but still, it seems like maybe the costs of active funds is like, same proportion or stays a similar proportion to the index fund costs. The point they make here is, again, even though like index fund investing and ETF investing increases, this doesn't mean, that private investors come to their senses. Many use the ETFs and index funds to make specific sector bets, which doesn't really make a lot of sense, or at least, begs the question, why do private investors accept the fact to invest into ETFs instead of stock picking, but then vehemently still try to country and sector bet? Here, we also have this point that, the truly total market index funds are, are staying smaller for excess monthly returns. Here also they talk about this misconception that you have this impression that the big index funds, also hold a lot, like really high percentage of the large cap stocks, but actually the biggest share is in the, mid cap stocks. And then also it's a reassuring fact that it does not seem like that, the passive investing is, there's still more active investing going on. Even though, of course, if we look at this, 2006 going to 2024, that is big change. If it goes further like this, at some point, maybe active and passive investing, trading volume will be the same. I'm not sure if there's, if that is a concern, but, considering that they want to reassure us with this figure, maybe it's looking at it again, maybe it's not that reassuring as I thought it was at the beginning. But this seems really nice, that it seems like market volatility is not increased by the increase in index funds, and that the really high volatility spikes seem rather, related to this macro stock market events. And which seems like, healthy indication of the, stock market. Market remains resilient of the volatility. So we learned, at least I learned the word of dispersion, the concept of dispersion. I'm not quite sure how interesting that actually is, but at least it doesn't seem like the level of dispersion has dramatically changed. So that already seems reassuring as well. Dispersion has remained unchanged. I'm not sure if I would agree that this still represents a great opportunity for active managers, as the reason that most people are now investing in ETFs is that exactly the reason that it doesn't seem like active managers are actually doing anything useful, And that's it. Thank you so much for tuning in. Let me know how you liked it. What are your thoughts on this paper? And if you are interested in, me going through more Vanguard research, or if there's another paper you would like me to cover.